Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, I am Paul Winkler. PaulWinkler.com is the website. And yeah, so there are some changes to 401ks coming to a neighborhood, near you. We're just talking about getting involved in 401ks. I like them because you're basically taking income and saying, I don't need it today, give it to me at some point in the future when I don't have income. So you're deferring your income to the future. And, one of the things that we often talk about is, hey, I can't afford. I was on Channel 5 this week, and, that was one of the topics. It said, how do you get to the point where you're actually putting more money away in your 401k? Well, maybe each raise that you get, if you get raises, hopefully you do, you take that raise and you put at least part or some or all of it in your 401k. And then before long, you might be up to like 15% of your pay going into the 401k. That's kind of what you shoot for. Typically, it depends on your age. If you're younger, might be slightly less. You can get away with that. But if you're older, you might be wanting to do more. So for the people that are older, this is a big deal with the changes that are coming because they have a maximum contribution in 2024 of $23,000. Now, for some people, that's just way out of reach. But that's going to be going to $23,500. There are some people in the listening audience that go, yep, I'm going to do that. I want to do that. Get an increase of $500. And because what they found is that 14% of people out there in 401ks do contribute the maximum. I was surprised at that number, 14%. It's higher than what I thought it would be. Catch-up contributions. So let's say you've reached the age of 50 and they look at it and go, hey, in your younger years, you may be struggling just to make ends meet. And maybe you're just getting a family started, getting your home started. You're just getting things going. And maybe you didn't put money away as much as you could. Maybe you were putting a small amount. Maybe you're only putting up to the match that your employer. And I typically, if you've got one, I'm really a big fan if we can get up to the match that the employer is putting in there for you for free, try to do that. But let's say you're one of these people, you just didn't do that earlier on in life. Well, when you hit age 50, you have a catch-up contribution. And that is where you can put another $7,500 is what that is for 2024. That number's not changing. But now you got $23,500 plus $7,000, so you got $31,000 that you're able to put away pre-tax. Or if you're doing a Roth feature, if somebody has a Roth feature, well, for a lot of people that are in higher income tax brackets that can afford to put away that much, you have to really be careful about paying taxes and then putting into Roth, just simply because, you may be actually deferring to a point in the future where your taxes are lower because you're not working anymore. So I really have people think hard about that. I've heard some financial firms just tell everybody to do it. And I gave a really egregious example a couple of weeks ago where this guy had like a $700,000 or $800,000 IRA, and the firm told him right away, do this right away. You take all of it and convert it. And I walked through the tax ramifications, and it was absolutely awful. So you have to be super, super careful. A lot of times what happens is, people, they go by rules of thumb. I've heard that with a lot of times with financial people trying to make things overly simple. They have rules of thumbs about things, and they just tell people, do this. Like I hear people just do an index fund. Well, you look at indexes and, some asset classes indexes work. Some asset classes indexes do not work very well at all. I had a client actually talking about his son. He says, yeah, his dad was saying, Dad, who's my client, said my son's talking about, just putting everything in these index funds in various asset categories. And I says, you may want to point this out to your son, because this asset category, the difference in return over the past 25 years is about 3% per year lower in the index fund. And in this asset class over here, it was 1% to 2% lower per year for the last 25 years. After a while, that really, really adds up. That's a huge difference between those. So you got to be really careful. The idea behind an index fund is just you're tracking a certain area of the market. But what they do with them is they're very lazy. Because of the way they're marketed, they're just using the name of an index, and they're cap weighted. They're overweighting the big companies. So that can be a problem. So watch out. Rules of thumb in general is something I tell people to be very, very careful. Some people say always pay off your mortgage, and sometimes it may be a good idea to pay off a mortgage early, and sometimes it doesn't make sense. Always get a 15-year mortgage. I hear that, and I say, well, I've seen circumstances where a 30 would have made actually more sense. So I like being very, very particular to somebody's circumstances as to what they ought to do. But back to this, it says, thanks to the Secures Act 2.0, those approaching the end of their career can now actually supercharge their savings. This is something I've talked about a little bit, in that you have people that they have these extra catch-up contributions for people age 60 to 63. So you can have an older worker can make an additional 401k contribution of $11,250 in 2025, and and that totals out to $34,750. So you have somebody that has a little bit of extra that they want to put aside, and you're between the ages of 60 and 63. That catch-up contribution is actually increased for that particular, and I don't know why they did that. It was kind of a weird thing, just for age 60 to 63, and that's it. But anyway, that's what it is. And the other thing is that the income limits are changing for the savers credits. Now, some of you may not recognize that there are these things called savers credits. So what that is, it's for a lot of people, they're not putting enough money away for retirement, and they're not putting enough money away for at all in retirement. And what happens, you have this in 2024, the savers credit works like this. You can actually get a credit of 50% of your contribution if you're married filing jointly and your income, your AGI, is not more than $46,000. And for other filers, it's going to be AGI of $23,000. So literally, when you put money away, you can actually have the government contributing. So this lady contributes $2,000, let's say, and into her IRA. And after deducting the IRA contribution, her adjusted gross income is $39,000. She may claim a 50% credit of $1,000 for the $2,000 IRA contribution. So that's how this can work. So this is something to talk to your tax people about. If I'm putting money into an IRA, can I get a credit based on my income? There's a credit up to 50% for an AGI that's not more than $46,000. There's another threshold. You get 20%. It's a lot lower. It's something. It's better than poking an eye with a sharp stick, but it's lower. It's $46,000 to $50,000 for married filing jointly. If your income is between those two numbers, you might have a credit of 20% of the contribution, and then it's 10% of the contribution from $50,000 to $76,500. Now, those numbers are roughly half. If it's not exactly half, but it's pretty close for all other filers. So if you're single, it's up to $23,000 for 50%, $23,000 to $25,000 for 20%, and $25,000 to $38,250 for 10% of the contribution getting a credit. Now, tax credit is a bigger deal than a tax deduction, because it's dollar for dollar off of the taxes. Now, if you're one of those terrible rich people and you have income of over $76,000, forget it. You can't do it. Or $38,000 for single people. So anyway, it's something to get people to save. And it is literally, I think it's just a statement by the government saying, hey, we are not going to take care of you from cradle to grave. You got to take care of yourself. And we're going to give you some carrots, in order to get you to save some for the future, and encourage you to do a little bit more of that. So just keep that in mind. There was also, in Market Watch, there was something I was going to comment on. They were talking about selling treasury bonds, or should we hope for a rebound? And again, I hit this because if you look at long-term bonds, a lot of times people make the mistake in their investment portfolios of holding long-term bonds in the safe part of their portfolio. And I tell people it's anything but safe. Now, the thing to look at, you may not look at this, but I'm going to tell you, this is what we look at. I'm looking at the duration of your bonds in your portfolio. So let's say that you're getting near retirement, and you have this investment portfolio that's allocated between stocks and bonds. Typically, as you get older, I'm going to be backing off of stocks a little bit. Now, not too much, because now I've got too much inflation risk in my portfolio if I don't have some equity exposure or stock exposure. So you got to be super careful about not overdoing this. I see people, they get all in fixed income investments, and then they get in retirement, and now they've got a problem where they're not keeping pace with inflation. Matter of fact, I may give an example of that. I was doing some work on a spreadsheet earlier, and I was like, whoa, this number is eye-opening. What if you put all your money in like a prime money market in the year 2000 and took an income? And what would it be versus if you had followed, and I use that days because when I opened the company was the year 2000, and it's also good because it is the worst time to start investing or pulling money from an investment is into a market downturn like what happened in 2000 through 2002. And a lot of people, I don't know, right? Yeah, they think that's not going to happen. I'm like, oh, beware. Stock prices are, for large U.S. stocks, are selling for actually above what they were selling for in 2000. So, when I talk about taking an income, I'm talking about following what I teach on the show. And that is much more broad diversification. But when I'm talking about the bonds, recognize that when you try to shoot for higher interest rates in your bonds, in your portfolio, there are only a couple of ways to get higher interest rates. One of them is lend money to companies with one foot on a banana peel and the other in bankruptcy court. So you're talking about what we call high yield or junk bonds. You can get higher interest rates, but when the economy goes south, those are the people that can't pay their debt. The other way to do it is increase the maturity length, or an easier way to measure that is using what's called duration. And when you have high duration bonds, let's say 10 duration bonds, when interest rates go up 1%, your bonds go down 10%. Well, when interest rates go up, that can cause stocks to go down. When stocks go down and your bonds go down, that's trouble. So what they're talking about in MarketWatch right here is they're talking about investment professionals. They're advising investors to wait until the end of the year to sell. And I'm like, well, wait a minute. Number one, you're telling them to wait till the end of the year. The problem here is this, for me, is why did the investment professionals get them into these bonds in the first place? They were the wrong types of bonds. What happens is that I want to look at those maturities and the durations, and I want to keep them shorter. Now, there may be some bonds that you have that are too long in duration and they've lost money. I wouldn't be selling it for tax reasons. I'd be selling it to make sure that the bond mix is correct for the, and they use the Vanguard long-term treasury ETF here. And that's, you have these bonds, 20 durations, and they're talking about the problem with these things. They went down 10% in just the past 2 months. 10% decline, just 2 months. This is a safe portion of your portfolio. And I look at that and go, what could happen? You could have another interest rate increase. Who knows? If the economy starts getting better, if things start looking better, just because the Fed reduced interest rates not too long ago doesn't mean that they aren't going to have to reverse course and interest rates start go up on the short end. But here's the thing. The Fed does not control long-term interest rates. And that's what you are subject to with these bonds. If you see all of a sudden that the economy starts to get a little bit better, and all of a sudden now you're looking at maybe the future's looking a little bit brighter. It doesn't take much for those long bonds that are very, very low right now to jump up in value. So I would be very, very conscious of what your situation. I'm not giving advice here because I don't know your situation, but be very conscious of doing it as this article is talking about, doing it for the sake of tax management. And they're saying, wait until you get rid of it. I don't know. So, I might take the loss right now and take it off and take it against a capital gain someplace else. Maybe some other investment that I own that is inappropriate. I might have another investment in my portfolio and I might need to be rebalancing, and I might look at this one thing that went up a lot and it's overrepresented in my portfolio. I have very, very big growth companies right now selling for a very, very high premium over their earnings or over their book value. It might be a really good time not to wait 2 months to go and sell. Don't wait until the end of the year necessarily to do this. You may look at a situation where it could be tax advantageous to not do that. So I'd be very, very careful when I see this type of advice out there. I don't remember who sent me this article, but that's just my 2 cents regarding that.